China's weight in emerging market index drops to record low. Please subscribe to the channel and stay always updated with influential global events. Give a thumbs up to the video and share with family and friends, and keep them updated as well. Let's delve into the video now. China's share of a key emerging market equity benchmark dropped to a record low, highlighting how a bearish outlook for the world's second largest economy is diverging from the rest of an asset class it once dominated. The Chinese stock market accounted for 23.77% of the MSCI Emerging Markets Index as of December 31st, according to Bloomberg calculations, while Goldman Sachs Group Inc. put the latest weight at 26.4%, citing FactSet data. Either way, this is the lowest since 2017, when the New York-based firm announced the addition of China's mainland stocks, so-called A shares, to the index. The current weight is about 16 percentage points below the country's peak weight in 2020. China's impact on emerging markets has declined on several fronts, said Cesar P. Masri, the head of EM Cross-Asset Strategy Research at Goldman Sachs in New York. The most obvious is the decline in representation within the MSCI EM index, but equally important, China's economic spillover effects to other emerging markets also appear to be waning. Accordingly, we find investors are more willing to express views within the EM complex without requiring an underlying bullish China view. Global investors are reducing their exposure to Chinese stocks as the economy struggles to recover from a pandemic slump. Regulatory flip-flops raise the risk of investing in the country, and domestic confidence remains subdued after a debt crisis battered the property sector. The nation's stocks have erased almost $4 trillion in value since 2021, ranking among the world's worst performers last year in a trend that's continued into the start of 2024. China's lower weighting in EM benchmark indices is a reflection of the poor market performance, reduced investor positioning and significant capital outflows, said Nenad Dinik, an equity strategist at Bank Julius Baer in Zurich. Continued weak economic data and regulatory crackdowns over the holidays have cast a shadow over the outlook for Chinese equities. Unexpected decline. China's decades-long campaign to integrate with global markets bore fruit in 2017, when MSCI said it would add mainland shares to an index that already included Hong Kong-listed Chinese equities. The inclusion began on June 1, 2018, and was carried out over several phases. At that time, MSCI's global head of index research, Sebastian Lieblich, said China's weight in the emerging market gauge was expected to reach 42% eventually. The nation seemed to be on track to achieve that milestone as asset allocators began pumping in billions of dollars to rebalance their portfolios and gain more exposure to China. Citigroup Inc. predicted $48 billion of annual inflows to A shares, while MSCI said the initial inclusion itself could channel about $17 billion in passive funds, rising to $35 billion in later years. The rally that followed MSCI's inclusion helped add $8 trillion to Chinese stocks between 2018 and 2021. The country came to dominate emerging markets so much that money managers complained about the lack of attention and capital left for other developing nations. But the COVID pandemic disrupted the rally, and subsequent developments have caught many China bulls off guard. President Xi Jinping's Common Prosperity Program raised regulatory risks for Western companies operating in the country, while the nation's ultra-strict COVID-0 policy, geopolitical standoffs with the US, and a property crisis that has already sparked several bankruptcies, all contributed to a turnaround in market sentiment. Those factors have pushed China's index weight to the lowest ever in the period since the A-share inclusion. The weighting was lower before mainland shares were included. Extended Weakness Bank of America Corp. said that by December 2023, China had become the least loved stock market in Asia. So far, this year has been no better. The Hang Seng China Enterprise Index has slid 5% already, the second worst performance in the world after Lebanon. The A-share benchmark, the Shanghai Shenzhen CSI 300 Index, is down 4.2%. China's loss in index weights is being compensated with gains in other major emerging markets. India has increased its share to a record 16.7% of the MSCI index, more than double the 7.7% weight it had in March 2020. Taiwan at 16%, South Korea at 12.9%, Brazil at 5.8% and Saudi Arabia at 4.2%, all increased their weightings last month. Any rebound is likely to be tactical, with little to arrest a long-term decline, according to Julius Baer's DINIC. Both valuations and investor positioning in Chinese equities are approaching historical lows, which suggests that the market trough may be near, he said. Nevertheless, we believe tactical rebounds will be short-lived. In the 21st century, China's economy continued to flourish. The country became the world's factory, its economic might reflecting in the emerging market equity benchmark. However, it was not all smooth sailing. The global financial crisis of 2008 did leave its mark, but China managed to weather the storm better than most. Now, let's jump to 2020, a year that marked a significant shift. The COVID-19 pandemic, along with increasing geopolitical tensions, led to uncertainties in China's economic outlook. This was reflected in China's share of the emerging market equity benchmark, which started to trend downwards. As we arrive at the present day, it's clear that China's economic journey has been a rollercoaster ride. From an impoverished nation to the world's second-largest economy, China's economic status in the emerging market equity benchmark has seen significant ups and downs. The recent drop in China's share of this benchmark is indicative of the bearish outlook for its economy. This divergence from the rest of the asset class, which China once dominated, is a reflection of the changing global economic landscape. This timeline gives us a clear picture of China's economic journey and its influence on the emerging market equity benchmark. Now that we have understood the past, it is time to analyze the present. Let's delve into the current status of China's economy. The once roaring dragon seems to be showing signs of fatigue. The country's share of a key emerging market equity benchmark has dropped to a record low. This is a clear divergence from the rest of an asset class that China once dominated. What could be causing this drop? Several factors come into play. First, China's economic growth has been slowing down. This has been caused by a myriad of reasons, including an aging population, a shift from an export-led economy to one driven by domestic consumption, and a crackdown on excessive debt. Secondly, the ongoing trade tensions with the United States have taken a toll on the country's economic health. The uncertainty has led to a decrease in foreign investments, further weakening China's position in the emerging market equity benchmark. Thirdly, the strict regulatory measures imposed by the Chinese government have caused a stir in the business environment. These measures have impacted major sectors, including technology and education, causing a ripple effect on the country's economy. Lastly, the global pandemic has had a significant impact. While China was the first to recover, the recent resurgence of cases has led to new restrictions impacting economic activities. Despite these challenges, it's important to remember that China is still the world's second-largest economy. The country's economic policies and strategies are continually evolving in response to these challenges. However, the drop in China's share in the emerging market equity benchmark cannot be ignored. It is a clear indication of a bearish outlook for the country's economy, contrasting sharply with the bullish outlook for other emerging economies. As we can see, China's economic status is indeed experiencing a significant shift. So, what does this shift mean for China and the rest of the world? Well, the implications are multifold. For China, this decline in equity benchmark could signal a need for introspection. It might have to revisit its economic policies and find ways to restore investor confidence. Let's remember, China was once the powerhouse of the emerging markets. However, these recent developments suggest a bearish outlook on its economy, which could have ramifications on its position as the world's second-largest economy. In the global context, this shift could lead to a redistribution of investments. Investors, always hunting for the best returns, might find potential in other emerging markets that show promising growth and stability. This could stimulate growth in these regions, potentially creating a more balanced global economy. But let's not forget, the world of finance is not immune to fluctuations. Current trends might indicate China's decline, but it doesn't necessarily spell a permanent downturn. The Chinese economy has shown resilience in the past, and it wouldn't be surprising if it manages to bounce back. Now, if we look into the crystal ball of potential future scenarios, we might see a few possibilities. If China manages to turn things around, we could see a resurgence of its dominance in the emerging markets. However, if the bearish outlook persists, we might see other nations stepping up, creating a more diverse and dynamic global economy. Either way, these changes underscore the need for investors to stay nimble and adaptable. The world of investing is never static, and the ability to adjust to shifts, like the one we're seeing with China, is key to long-term success. As we wrap up, it's clear that the landscape of the global economy is changing, and China's role is evolving along with it. Before we conclude, let's quickly summarize the key points we discussed today. We've traced China's economic journey from its previous domination to its current record low in the emerging market equity benchmark. We've looked at the bearish outlook for the world's second-largest economy and how it's diverging from the rest of the asset class it once ruled. We also discussed the implications of these changes and potential future scenarios. Despite the current challenges, China's economic journey is far from over, and it will be interesting to see how it navigates this new landscape.